This is level 1 of the CFA program, the topic on derivatives and the learning module on pricing and valuation of options. You might be tempted to think that the words price and value have identical meanings, and in general they probably do. But recall when we were trying to figure out the price or value of a share of stock. Remember, we used the Myron-Gordon growth model, and that model helped us to compute something known as the intrinsic value of a share of stock. Then we did bond pricing, and we used the yield to maturity as an input variable, and we computed some theoretical value of a bond. Then remember, we used spot rates. Then in level 2, we're going to use an interest rate tree, and we're going to do all different sorts of models to come up with the theoretical value of a bond. So I want you to think of it in this way, that the price of any security, including an option here in this learning module, is pretty much the price that a buyer and a seller, a willing buyer and a seller, agree on the floor of some exchange, whether it's a physical exchange or an electronic exchange. Valuation is the result of some type of a theoretical model. Now, the valuation models and the term value, when we get to derivatives, has some implication for the current market price of the derivative as we go through its life. So my point of all this is the distinction between price and value becomes even more important the more complex of a security that we're examining. And you'll see that as we go through this. So just 3 LOSs in this module. We'll talk about exercise value, and the beginning of the reading also uses the term intrinsic value. So you might you can use those two terms interchangeably. Moneyness, time value. Time value is going to be really, really important, especially when we get to level 2 and we introduce some other kinds of option pricing models. And then, as you can imagine, in almost all of our derivative conversations, we need to talk about arbitrage. We'll talk about replication. This is a cool thing. We did a little bit of that before in one of the earlier modules. And then we'll look at the 5 or 6 factors that will determine the value of an option. So relatively short module, but some really important questions here. And what we're going to learn is that to be able to answer the math questions, now notice, explain, contrast, and identify, there's really no compute or calculate in here. However, to understand exercise value and moneyness and time value, you need to go back to kindergarten. All we're going to do is say, which number is bigger? You have 3 apples over here, and you have 2 apples over here, 2 apples over here. So kindergartners can solve that problem, and using that simple math is going to be able to do it for us here as well. All right, so let's start with some notation. Look at the top gray box up there. So we have exercise values of calls and puts. We have the price of the underlying. And so typically you use the uppercase S because in most cases, and that's what's going to be in our slide deck here, that underlying asset is a share of stock. Exercise price almost always is noted as X, although in some readings it could be noted as a K. When I teach this in class, I always write EP for exercise price on the board. All right, so this exercise value of an option at maturity. This is one of the cool things that we do to understand derivatives is that we go ahead and skip to the end. Remember, we did that with a forward contract. We did that with a futures contract to see the simple math that results at the end of the contract. And so it makes sense to go ahead and do this at the expiration date of an option. And this is super easy. This is what I was telling you about, the 3 apples and the 2 apples. So the value at expiration date of the option is either going to be 0 if the option finishes out of the money. I have a couple of slides that'll explain that here in just a second. Or it's going to be the simple difference between that future stock price, that future price of the underlying asset, S sub T, minus the exercise price of the option. So let me just give you just a super quick example for a call option. If the exercise price is 100 and the underlying stock price is 120 on that date, you have the right to buy at 100 when you would have to spend 120 on the floor of the New York Stock Exchange. So the difference between those two prices, $20, is the exercise value of the option on the expiration date. And of course, for a put option, you just flip it upside down and you change signs. And so the exercise value of a put option at expiration date is the difference between the exercise price and the stock price. And so please don't get confused on the exam. Just remember, and this is a great exam question, by the way, just remember that when you buy the call option, you're betting that prices go up. So if the price is above the exercise price, you win. If it's below it, well, then you allow the option to expire and your option is worth zero. Excuse me. For a put option, it's just the opposite. If the stock price is lower, and of course you're betting that the price is lower for a put option, then you win. If it's higher, then it's zero. So that's why the notation is always the max, and then there's parentheses, zero, and then the difference between those two. So just think about 3 apples and 2 apples. Now, of course, the more interesting question is, what is the exercise value between the initial date of the option, when the option was created and sold, and the expiration date? So notice what we have up there in the bolded red box, exercise value at any time. So if this is a 6-month option, then we can compute the exercise value on day 1 and 2 and 3 and 4 and 5 all the way up to, however long it takes to get to that expiration date. Now, recall when we computed the intrinsic value of a share of stock and we computed the theoretical value of a bond, that I told you this multiple times, and I'll repeat this in level 2 and in level 3, that the price of any security, the value of any security, has to be a present value, right? Now, we had one little caveat when we did a forward contract and a futures contract. The value was a future value, but here we're taking present value. So look at the value at any time before the expiration date of a call option in the blue box. And what we're going to do is we're going to use this same equation. Let me go back here, right? There's, for the call option, S sub uppercase T minus X. Notice we have the same thing there, but there's a bunch of stuff over on the right-hand side of the X, and that's just taking the present value. So we're going to multiply it by 1 plus R raised to the minus, and we're going to take the difference between the longer term, right? The T is all the way to the end, minus that time period in between. So when you raise something to the minus, you divide, so we're taking present value. And of course, then it's the same thing, but just an opposite of in the green box for a put option, because we're betting that the price is going to fall. So this is a super easy question. All we're doing is saying that exercise value during the life of the option is, well, let me go back here. It's the stock price minus the present value of the exercise price. So at maturity, it's just minus the exercise price for the call. Here, it's minus the present value of the exercise price. And as I tell my students all the time, that this is consistent with the price of a share of stock, right? We did the Myron Gordon dividend discount model, which is a present value. And then we used our 5 time value of money buttons on our calculator to compute the theoretical price of a bond. So that's present value. So here we're just being consistent with the valuation models that we've learned throughout the CFA program, and you probably learned as an undergraduate. So let's go ahead and take a look at a quick example. 2-year call option, exercise price of 100, risk-free rate 2.31%. 6 months into the contract, the underlying spot is $98. All right, so let's think about this. Before we compute that exercise value, what do we have? The right but not the obligation to buy a share of stock at 100 when the price is only 98. So we can go to the New York Stock Exchange and get it for 98. We're not going to exercise this option and pay 100 because we would lose $2. All right, but that doesn't mean that the option is worthless. It just means that the option is out of the money and that we're probably willing to pay less. The exercise value is less. So do the math real quickly here. So let's take the maximum of 0 or 98, there's our spot price, minus the present value of the exercise price. So make sure you raise it to the correct exponent, because you know the institute is going to have 0.5 in that exponent, right? 6 months. So make sure you do the 2-year call option. So however many times that is, that's 2 minus a half a year, right? So that's 1.5. Don't put 0.5 in there. And please make sure that you put the minus sign up there just to remind yourself that you're taking present value. So the exercise value of this is 137. Now, I've been using these terms here, and I'm guessing you remember this from some other kind of a visit between us or in your earlier lives as students. The moneyness of an option, it's really just a measure of the relationship between the value of the option and its exercise price. So let's do the simple one first. An at-the-money option, whether it's a call or a put, is a scenario under which the underlying asset, in this case S sub T, stock price, is equal to the exercise price. And so, this is what happens when financial institutions write options. What they do is they look at the stock price. Let's just suppose it's 100. And so they'll say, you know what, we're going to write 10 options on this share of stock. Let's just start with an exercise price of 100. So they start with an at-the-money option, and then they'll say something like, all right, let's write a bunch of options that are out of the money. So then they'll have, and these are call options, so then they'll pick 105, 110, 115, and 120, or, usually it's a $5 increment, but it could be almost anything. And then they'll go down 95, 90, 85, and 80. So what is that? That's a total of 9 options that are written within $10 of the stock price. So what happens to the value of the option over time? It goes up and it goes down, it goes up and it goes down. The exercise price, of course, is fixed. So the only time that any option is at the money is when the stock price is going up and then it actually hits that, and then it's going down and it actually hits the exercise price. So, of course, the more interesting questions then are, what happens when the underlying spot price is different from the exercise price? And let me just quickly do this here. Out of the money is one relationship. In the money is another relationship. So you need to pay a little bit of attention to whether the question stem tells you that it's a call option or a put option, because the relationship then is just reversed. So let's start with a call option in that blue box. Remember that if the stock price is above the exercise price, we call that in the money. We buy the call because we're betting that the price goes up. So if the stock price is, let's say, 120 and the exercise price is 100, then we say that call is in the money. Just the reverse is true for a put option. If the exercise price is 100, you have the right but not the obligation to sell at 100. And if the stock price is only 70 or 80, then we say that put option is in the money. Now, the reading does emphasize this concept of a deep in the money option. This is one that is highly likely to be exercised. Let's do a call option here. Suppose that the exercise price is 100. And the stock price is, let's say, $200, right? What does that tell us? That means that you have the right to buy at 100 when the price is double that, So, hey, this is great news if you own that call option. Well, what the reading emphasizes is that if the stock price goes up to $201, right? It was 200. If it goes up to $201, then the option price, the value of the option, is probably going to go up by that same $1. So look at that arrow point down there. The option has a 1-to-1 correspondence between the option price and the underlying stock price change. So that's an important thing to remember because the learning module emphasizes it. Let me go ahead and give you just a little bit of a general idea here. Suppose we have an at-the-money option, one in which the exercise price and the stock price are $100. If the stock price goes up to $101, the option price is not going to increase by $1. It's probably only going to increase by about 50 cents. But if you have a deep in the money option, it will go up by a lot more. Maybe it'll go up by that $1. So option has a 1-to-1 correspondence. And then just the opposite is true here for an out of the money option. Let's suppose you have the right but not the obligation to buy a share of stock at $100. And the price is just $50 or $60. Well, why would you go to the New York Stock Exchange and pay $100 why would you exercise your option and pay $100 when you can go to the New York Stock Exchange and pay $50 or $60? There's a deep out of the money option is very unlikely to be exercised, which means that if the stock price goes up by $1, the option price might go up by, I don't know, a nickel or a penny. Let's do a quick example for Apple. Notice that the dotted line going across there is explaining the difference between the blue and the green squiggly little lines in or out of the money. So here we have a strike price of $150. And so notice in the blue line, over here, this is when the stock price is less than 150, so that's out of the money. And then notice in there, or what is that, early July or whatever that is. So it's a little bit above. So there's some green, so it's in the money for a little bit. Then it's out of the money, and then it's in the money for green all the way. Here's a good slide. You might remember that I sometimes asked you to get out your phones and take a picture of a slide and put it in a good file. I'm not sure if you need this one, but for those of you who feel like you'd like to have this one, this is probably a good one to take a picture. All right, what have we done to this point? We've done exercise value of the option. We've done moneyness. Let's do time value of an option. And this is what we're going to learn here. And this is probably among the more important components of this learning module, that a call premium and a put premium, or let's go ahead and say call price and put price, it has two components. It has exercise value and it has time value. So remember that exercise value, it could be 0, but it could also be some positive number. Time value of an option is always going to be positive. And that's because you always have a chance that the stock price, if you have a call option, may spike, and if you have a put option, it may dramatically fall. So look at that third teardrop point, the difference between the current option price and the option's current payoff, or we're calling that the exercise value. And it's just the opposite for a put. Oops, let me go ahead and explain the greens here just a little bit. So what are we doing here? Well, we're doing the same thing as we did before. We're taking that lowercase c sub t. There's the call premium or the call price. And we're just going to subtract out the maximum of 0 or the present value of the difference between the present value of the exercise price and the stock price. And so look at that lighter green box down there at the bottom, and you see the relationship between intrinsic value, or we're calling it exercise value here, and time value. So that's a really good relationship to know. Call premium has two components, exercise value and time value. And then, of course, we can switch colors down here for a put option, and we're just switching and standing on our heads because we're betting that the price falls when we own the put option. So let's do a quick example here. 2-year call option, exercise price 100. We've seen that before. Risk-free rate 231. 6 months into the contract, the underlying is 98. So we've done that before. But now the option premium is $1.88. What is the time value of the option? And all we're going to do here is take some present value. We're going to take that $1.88 and we're going to subtract out the present value of the exercise price, which we already did before, right? That's $1.37. So the time value of the option is 51 cents. So what did I just say a moment ago? Option premiums or option prices, they have two components. They have time value, in this case 51 cents, and they have exercise value, in this case $1.37. So, I ask these questions in my investments class and my derivative securities class all the time. So I'm guessing that this is a highly likely exam question for you guys coming up on level 1 exam. What is time value? So you think about it. So there's three values. There's the call price, there's the exercise value, and there is the time value. And so the Institute will give you two of those three, or they'll make you calculate it if it's a present value, like in this case. So this really is a little bit more advanced than what I said earlier about the kindergarten 3 and 2. But if you keep that in mind and just take 3 and 2 and then take the present value of 1, then you can do all this stuff here. Let's go ahead and move on to the next LOS. And as you can imagine, this kind of concept of arbitrage is going to play a super important role in the pricing of these contingent claims. We'll go ahead and talk about replication here in just a second. Let me go ahead and start by reminding you that when we entered a forward contract or a futures contract, that value at initiation was 0. So there was no capital that changed hands. And on the maturity date of the contract, clearly there was a winning position and a losing position, and those were symmetric payoffs. But it's not true with contingent claims, and we're focusing on options here in this part of the learning module. So note that when the option is created, the writer of the option is going to demand compensation. So contingent claims do not have 0 initiation values. In fact, the buyer of the option is going to pay a premium, that's the call price or the put price, to the writer or the creator of the option. And that's true because, and wait a minute, let me go back here, this is really cool. The option writer is going to demand compensation for both the time value of the option and the exercise value of the option. So let me give you just a quick example. Let's suppose that I write an option and the exercise price is $100. And let's just suppose that the underlying stock price is $110. So I'm selling you the right, but not the obligation, to buy shares of stock from me for $100. But if you had to buy these shares on the floor of the New York Stock Exchange, you'd have to pay $110, right? So this is a good deal for you. So if you showed up at my door and said, "Hey Jim, I'll give you $5 for that option," and if I were dumb enough to take it, I would say, "Okay, let me have that $5." And you would say, "Hey Jim, I'm going to exercise my option." Now forget about the difference between the European and the American option. Suppose you can just exercise this at any time. You would say, "Okay, Jim, here's $100. Sell me that share of stock." So I have to sell you that share of stock. And you immediately go to the New York Stock Exchange and sell it for $110. So you paid me $5 and you made $10. You bought low and sold high. That's a profit of $5 for you. So what would you do? Again, you would knock on my door and say, "Hey Jim, do you have any more of those $5 options?" And I would say, "Sure, here's $5. And I would lose $5 every time, and you would win $5 every time. So I would have to have lost any kind of brain functioning to do that. So I'm going to charge you a premium of at least $10 plus maybe $2 or $3 extra dollars. So that $10 is kind of like the exercise value, and then the extra $2 or $3, that's time value. So hopefully that makes sense in my little quick example there. And remember that the most you can lose owning the option is the price of the option. The most you can gain is, well, if you have a call option, I guess infinity is the most you can gain. I'm not really sure what that means because I've never seen a stock price selling for infinity. If it's a put option, you're a little bit truncated because the price is not going to drop below zero. You can't get to a minus infinity stock price. So that's what this whole conversation about asymmetric payoff profiles means. Now, what that also implies is there are going to be upper and lower no arbitrage price bounds at any time. So let's go ahead and talk about these just kind of quickly here. Remember that the call option will be exercised at expiration only if the stock price is greater than the exercise price. So that lower bound has to be the underlying price. So there's the S sub T minus the present value of the exercise price, right? There's that minus X times 1 plus R that we did before. So that upper bound is going to be S sub T. So this green box down at the bottom is probably the most important component of this particular part of the reading. So what are we doing here? That lower bound is going to be the left of the less than sign. There's the C sub T in the middle. There's that call premium or the call price. So what are we bounded? We're bounded on the high side by the underlying stock price. We're bounded on the low side by zero, or the difference between the stock price and the present value of the exercise price. So this concept of upper and lower boundaries due to arbitrage conditions are just a similar function to what kind of math that we've been doing all along. Put option, what do I do all the time? I'm just going to say let's turn it upside down, and so we'll do just the opposite. That P sub T, notice that's in between the two less than signs. And so we're upper bounded by the exercise price, and we're lower bounded by the difference between the present value of the exercise price and the stock price itself, or zero. Let's go ahead and do just a quick example, and this will make perfect sense. So 3-year call option, exercise price of 100, risk-free rate 1.5. 6 months into the contract, spot price is 105. So we have the right to buy at 100, and while the stock is trading on the New York Stock Exchange for 105. So what are these upper and lower bounds? Well, the upper bound, that's super easy, right? That's just the stock price, 105. And we're lower bounded at the maximum of 0. And it's probably not going to be 0 because we are in the money. So take the difference between 105 and the present value of the exercise price. Let me just call your attention once again. Notice we've raised it to the minus 2.5, which is consistent with what we did on that previous example. What we're doing is looking at the remaining time of the option. Now, one of the super cool things that we learn in derivative contracts is this concept of put-call parity, which we'll talk about in other recordings, and we'll spend lots of time in level 2 and even some in level 3 talking about this put-call parity. But essentially what it does is it says that there's a stock market over here, there's a credit market over here, like the U.S. Treasury market, and then there's an option market over here, and these markets must be intricately and intimately linked. And that's this concept of replication. And so if you don't like what's going on the floor of the New York Stock Exchange, in other words, if you don't like the price for Amazon or Apple, you can replicate the payoffs by going to the credit markets and the option markets. And so replication is just a strategy. What are we saying there in that sideways arrow point? Recreated by a combination of different kinds of securities. And so I think this is probably worth taking a picture of. So if we are long in the underlying asset, like a share of stock, and we're short the derivative, that's equivalent to owning, let's say, a treasury security. Now, of course, when you do this replication stuff, you have to be super cognizant of the timing. right? Let's take that first one. If we're long in the share of stock, right, there's no time constraint. We can own that share of stock for thousands of years. But if we're going to layer that with a derivative and layer that with an investment in, let's say, a treasury security, the timing of those short-termer things have to be identical. So short derivative, we need to make sure that the expiration date of the option is identical to the maturity date of that long in the risk-free asset. And then notice what we've done in the slide. We just have some arrows. All we're doing is algebra. We're just switching from one side to the other. So what grade do you learn algebra? 3rd grade, 5th grade. So that's all we're doing here. So take a picture of this slide so you know to be able to, well, what does that LOS ask us? You know, contrast the use of arbitrage. And so I can see the institute providing you with a question that says something like, hey, how can you replicate an investment in a 6-month treasury security? That would be long in the risk-free asset. So you short the derivative and you long the asset. Now, let's go ahead and take a look at this in a little bit more detail. How can we replicate a call option? Well, what we're going to do is we're going to borrow X, the exercise price, at the risk-free rate. Then we're going to take the proceeds of that capital and we're going to go out and buy the underlying security. All right. So what happens? At the expiration date, there are two possibilities, right? Stock price can either be above or below the exercise price. So if the stock price, now remember, this is a call option. So if the stock price exceeds the exercise price, we're going to go ahead and exercise. We'll sell the underlying stock and then we'll use the proceeds to repay X. If the stock price is less than the exercise price, then we say, okay, we're out. We're not going to exercise and there's no settlement needed. So we lose the option premium. So there's going to be this non-linear option payoff nature that requires that the replication be adjusted as that likelihood of exercise at the expiration date changes. Now we can do the exact same thing for a put option, but here we're going to short the price, we're going to short the asset, and then we're going to lend out. Remember, when we short, we raise capital, we generate income, and we're going to lend out those proceeds at the risk-free rate of interest. And so the two possibilities are identical, but they're mirror images of what happens with the call option. All right, let's focus on this last one here about the factors. And this is what we know. Notice down the left-hand column, there's 1, 2, 3, 4, 5, 6. So you got to memorize these 6 input variables that are going to determine the value of the option. You have to be completely aware in the question stem whether you're given a call option or a put option. I've mentioned that several times in this recording, but this is super important as you try to answer these questions. So going down that left-hand column, there's 6 input variables, which means there are 6 really good questions for a call option and 6 really good questions for a put option. So really all we're doing here is we're going to talk about sensitivities. We're going to say something like, okay, when one of these factors changes, what happens to the value of the option? Now, as we move through the program, we're going to call these sensitivities something else. We're going to call them the Greeks, right? These are all Greek letters like delta and theta and vega. Now, that's a conversation for another day, and those are really going to be really cool conversations. All right, so what do we know? When we buy the call option, what are we betting? Prices go way up. When we buy the put option, what are we betting? That prices go way down. So the value of the call option will increase when the underlying stock goes up. The value of the put option will increase when the value of the underlying stock goes down. Exercise price here, the higher the exercise price for the call option, that puts more pressure on the stock price to increase in value so that the option becomes in the money, so that you'll be willing to pay less for a call option that has a higher exercise price, and you'll be willing to pay less for a put option that has a lower exercise price. And there's an explanation there about the lower and the upper bounds. Time to maturity, this is an easy one for both the call and the put. So time value increases with time. So of course, you're willing to pay more for a call option and a put option that expires in 24 months than one that expires in 2 months. Risk-free rate, this has everything to do with opportunity costs. So you think about it in this way, that if we have an option, call or put has an exercise price of 100, and let's suppose it's an at the money option, so the stock price is 100. So you got to think about it. What would you pay if I'm writing this at the money option? What would you pay me as the option writer? Well, you might pay me, $2 or $3, whatever it is. Depends on some of the other factors. But think about this. So you pay me $2 or $3 to take a position in the underlying stock. I mean, it's a highly leveraged position. But if you were to go to the floor of the New York Stock Exchange and buy that share of stock, you'd have to pay 100. And if you sold that, if you happen to own that share of stock and you sold it today, you'd get $100, and then you'd have to reinvest that $100. So think about that. You get in the investment for just $2 or $3, which is super leverage. But if you had to go to the spot market, you'd be either in or out $100. And so that's opportunity cost, right? So when you go to the options market, this leverage means that, oh my gosh, you don't have to pay $100 to buy that share of stock. You only have to pay $2 or $3. So what do you do with that other $97 or $98? Well, you go invest it, and you invest it at the risk-free rate of interest. And if you can earn more money, if the interest rate is higher, then the value of that option is higher. For the call option. So look, notice those 2 block points. So call option, higher risk-free rate increases the exercise value of the option, right? And for the put option, a higher interest rate decreases the exercise value of the option. So those are 2 really, really good exam questions. Volatility, we're going to talk at length about volatility, especially when we get to level 3. We're going to talk about things like volatility smile. But for now, all you need to know is that when I'm going to draw a little line here. Ready? So how much would you pay me to write an option in which the share of stock did this? Can you see my little squiggly lines? So the share of stock, it goes up a little bit, goes down a little bit, goes up a little bit, goes down a little bit. It doesn't do much. Well, you're not going to pay me very much for that option. On the other hand, what if you do, how much would you be willing to pay me for an option on a share of stock that goes like this, way up and way down and way up and way down? So with this little squiggly line, you don't ever have a chance for the option to be like deep in the money, right? But here you have a chance. So remember, higher volatility increases the value of the option. Then the last factor is the income or cost associated with the underlying asset. Think of this simple example. If you buy a share of stock and that firm pays a dividend, well, you reach your hands out and say, hey, where's my dividend, right? You're legally entitled to receive that dividend. But if you own a call option on that share of stock, you're never going to receive that dividend payment because you're in the derivative market. The company doesn't really care how many options are written on its shares of stock. The company's never going to send you a check as the owner of the option. So whenever there's a dividend paid, the call option price has to reflect the simple fact that the shareholders are benefiting, but the call option holders are not. So notice what we have in that first arrow point there. Any income or other non-cash benefits decreases the value of the call option. Any costs, on the other hand, increase the value of the call option. Now, just the opposite happens with the put option. So any income, it increases the value of the call option, and any costs decrease the value of the put option. So get out your phones. Here's a great picture of a summary of what I just described. There are the variables down the left-hand side, and these are really, really good exam questions. And I think that takes us through the learning module. Boy, that first LOS is really important. Exercise value, time value, and moneyness. Moneyness is super easy, right? But you need to know those concepts to be able to answer arbitrage and those factors. So I want you to go to the end of this learning module. There's a really good one question at the end, and it summarizes all this stuff here. So thank you for watching, and good luck studying.